Good afternoon or even good morning, everyone. Many thanks for accepting our invitation, and welcome to this seminar on global monetary order at the critical juncture, the impact of digitalization and geo-economic fragmentation. My name is Ettore Greco. I am the Executive Vice President here at this Istituto Affari Internazionali, International Affairs Institute, and I am also the head of the Institute's program on multilateralism and global governance. I'm very pleased to open this meeting, which has been organized by our institute in close cooperation with Intesa Sanpaolo. Indeed, this meeting is part of the program that the Institute carries out in the framework of our partnership with the Intesa Sanpaolo, which I would like to thank very much for its continued support. The partnership, in a nutshell, aims at investigating the interaction between geopolitics and finance. In this context, a central area of our research have been, since the very beginning, since the outset of the program, the implication of digitalization and geopolitics on international banking and finance. And we have conducted a couple of projects and also produced publications in the last few years on the role on tech giants in banking, the emergence of cryptocurrencies, and the potential role of central bank digital currencies. In this meeting, we will present and discuss a volume which is the outcome of a research effort that we started several months ago. The volume is edited by two my colleagues, Nicola Bilotta and Fabrizio Botti, and includes chapters by other 8 authors who are leading experts in the field, who will intervene in today's panel. They will address the general theme of this meeting from, as we see, rather different angles and perspectives. And let me express our deep thanks to them for being with us today, for having accepted our invitation, and also, and not even more importantly, of course, their outstanding contribution to our volume. The volume indeed covers a wide spectrum of issues related to the future of the international monetary system, although I would add it focuses in particular on the implication of the ongoing and I would say accelerating geopolitical transformation in digital developments. In this regard, the volume offers an analysis of the current state of the international monetary system, and also in some part an historical account of the dollarization process, and more importantly, also discuss various possible scenarios of its possible future evolution. I would say this perspective approach is one of the strong points of this volume. The volume reflects essentially the efforts to look into the current geopolitical and technological trends and drivers in order to extrapolate the direction of change, what we can expect in the foreseeable future. And of course, I would say the title itself of this meeting can be, I assume, a matter of discussion, including the question if the international monetary system is actually at the critical juncture, and if we are actually witnessing an irreversible trend towards geopolitical and geoeconomic fragmentation, or even decoupling between different regions, possibly around political alliances. These are, of course, elements that we have included in the title, but need to be discussed because represent subject of, I would say, hot debate nowadays. The volume features chapters that mainly examine the general trends, but also other chapters on more specific issues, focused on the euro, the role of Europe in dealing with the trend towards politicization of finance, and two final chapters on China, more specifically the role of renminbi in Russia. And this last chapter deals in particular with the role of Russia's gold reserves. One important issue we want to discuss in particular that we like to mention is the potential emergence of a more diverse international monetary system. That's, of course, a central subject to be discussed. We know the US dollar remains by far dominant, but there are, in fact, some trends that indicates that because of some developments, this picture may change, and these developments may lead to a gradual erosion of this role of the dollar in the international monetary system. Of course, this is just one of the topics that relates to the transformation of the international monetary system. I think we have indeed a very rich menu of issues to discuss, and I wish again to thank all of you for being with us today, and all our panelists and speakers. I very much look forward to our debate. I have now the pleasure to give the floor to Hugo Doyle, Senior Director, Head of International Public Affairs of Intesa Sanpaolo. Hugo,
thank you.
Is yours.
Thank you, Ettore, and thank you for all the participants, both in presence and online, and to Fabrizio Botti and Nicola Vilotta, who have been the drivers of these seminars that Intesa Sanpaolo is very happy to associate its name to, and that have been unfolding for quite a few years. Just recently, I remember with pleasure the ones that we have had on the geofinance and geoeconomics of space and the regulatory framework connected to these aspects, and also the path towards a greener central banks and all that it implies for sustainable investments. Of course, what we have noticed in this partnership with Istituto Affari Internazionali is your capability of choosing topics that by choice or necessity become definitely hot topics through time. And definitely the topic of geoeconomic fragmentation and its corollary of the weaponization of finance is a clear example. Just to give you some empirical grounding of what I'm saying, the IMF produced back in January this year a very interesting paper on geoeconomic fragmentation and the role of multilateral banks, to be followed actually this month in parallel with the spring annual meetings, with single chunky chapters of both the World Economic Outlook and the Global Stability Report on geoeconomic fragmentation and foreign direct investments, and the spin-off effects of geoeconomic fragmentation on financial equilibria. So well done in having chosen well in advance such an important topic. I won't focus into the details of the book. Of course, our keynote speaker and our panelists are definitely way more equipped than myself. I might just add a couple of points to discussion, if I may, on these matters. And the first one, with respect to geoeconomic fragmentation, is the framework of sanctions. When economic sanction and financial sanctions are levied or are dished out by a subset of countries, subset compared to the UN, i.e. when sanctions are not under the UN framework, but are the result of the actions of, let's say, like-minded nations, as is currently the case. As with all sanctions, these are typically drawn with the focus of doing what you call a minimax approach. So maximizing the consequences, the negative consequences on the geographies that are targeted, with the view of minimizing the negative consequences of for the countries that are dishing out these sanctions. And this is typically what is the, how can I put it, the tactical view of sanction designing. But I'm wondering if in the current context, we are seeing, fair enough, a minimax approach tactically, but with the unwilling strategic consequences that now the dollar framework within which we've been living from Bretton Woods onwards is being potentially challenged by those countries that are non-aligned necessarily and that did not adhere to the sanctions framework. Just to exemplify what I'm saying, a few days ago, President Lula was in China, and he raised the thoughts of potentially looking at a common currency amongst the BRICS countries. No? So, of course, there's a lot of issues that need to be tackled if that bird were ever to fly, and I have a lot of doubts on that. But I would think, and this is what I'm trying to offer to the audience, that the minimax approach to sanctions levying sometimes might spin off with negative consequences that are not minimax, but can be max, if that's the word. So we shall see what happens. Of course, we are way far from a world where the dollar doesn't have the role that it currently has. Just to give you an example, speaking again of Brazil, which, by the way, will have the G20 presidency in a few months, more than 80% of the central bank reserves that are a good proxy of the effective currencies that are part of that are underlying economic flows. Well, more than 80% is dollar, and not even 5% renminbi as ballpark measure. The second thought is on how something that has emerged in the recent years, which is what is known as open source intelligence, or OSINT, has effectively impacted additionally on geoeconomic and more so geopolitical equilibria, because the capability of making actions of state and non-state actors accountable by the traces that they leave online has definitely become very relevant. And both state actors and non-state actors are able to access an amount of information and a quality of information that makes actions recordable. So what I'm trying to say is that another source of fragmentation, maybe in the short run, and not in the long run, is open source intelligence. When I say not in the long run, is because if one is accountable and one realizes that one is accountable, when potentially you put your actions in line with what traces you will leave behind. So on these 2 pence worth of wisdom, I give it to you. Thank you.
So many thanks, Hugo. And now I have the great pleasure to give the floor to Michele Zavini Zangrandi, Head of Digital Globalization, International Relations Department of the Bank of Italy, for his keynote speech. Let me stress, of course, that Bank of Italy has done extraordinary and excellent work to shed light on many of the issues that we will discuss, and particularly the process of digitalization and its impact on the international financial system, which has been for us, of course, a source of information, but also would say inspiration. And we have been, I think, in close contact with the Bank of Italy. So many, many thanks for accepting our invitation. Please, I invite you to go to the podium for your keynote speech.
Good afternoon, everyone, and thank you for giving me the opportunity to share some thoughts today. So first, I'd like to thank the Istituto Affari Internazionali for hosting this very topical event. And I'd also like to commend the authors of the report and the members of the panel for their excellent and stimulating work. Before getting started, let me state the usual disclaimer, which is that all that follows is my personal view and should not be attributed to the Bank of Italy. So the topic we're discussing today is fascinatingly complex. And that's because the global monetary system is a fascinatingly complex construct. The global monetary system, in fact, is the result of multiple and overlapping factors, which include geopolitical and economic forces, economic and political equilibria within individual countries, and last but not least, also choices of the private sector. So when discussing this topic, the question that most often comes to mind is which currencies dominate in international payments and how long they might hold that role for. And this is rightly so, given the level of innovation we're seeing in the payment sector and given the shifting geoeconomic landscape. In these few minutes today, however, I'd like to focus on a deeper seated and slower moving aspect of the international monetary system. And that's the net of foreign assets and liabilities that derive from international payments and that tie the global monetary system together. So to start, let me take the example of international trade to draw the link between international payments and foreign assets. In international trade, goods and services flow from an exporter to an importer, and money flows the other way. From a banking perspective, this transaction amounts to an exchange of bookkeeping entries between domestic and foreign banks. And at the macro level, this results in the exporting country holding some claim on the importing country. This means that for countries that export consistently more than what they import, they can build claims on the rest of the world, which can be fairly large claims. Now, these claims are this country's foreign assets, and they can be used to pay for imports, or they can use to build up foreign reserves, or they can be turned into foreign investments of various types. Now, since someone's asset is someone else's liabilities, international payments create a net of interdependencies in the form of foreign assets and liabilities. Now, to get a sense of how these interdependencies are pervasive, we can look no further at the example of the US and China. So China is one of the world's largest exporters, and over decades of trade surpluses, China has accumulated foreign assets for approximately 10 trillion US dollars. And this is to get a sense of how large this is more than half of China's GDP, and most of these assets are in fact denominated in US dollars. Now, this depends on the fact that the US is one of China's largest export destinations, of course, but also depends on the fact that the US is the only country that is capable of supplying the rest of the world with a sufficient quantity of safe and investable assets. Both China's ability to run these consistent export surpluses and the US's ability to accommodate the enormous capital inflows that providing foreign asset implies are the result of deep-seated economic and political features of the two countries. And the dynamic that results is made even more robust by some economic interactions between the two countries. For example, as Chinese capital finds a home in US domestic market, this drives domestic borrowing costs down in the US. This stimulates consumptions, which in turn means more imports, which likely come from China, coming full circle. So just as China is heavily invested in the US dollar, so is the rest of the world. To get a sense of how big this is, consider that as of last year, US gross external liabilities stood at approximately $50 trillion, which is 2 times over US GDP. These are not just US liabilities, of course, these are assets to dozens of countries, including China. And the demand for dollar assets is so strong that approximately half of all international debt securities, a $30 trillion market, is denominated in US dollars. In sum, and where I'm getting at, is that the global monetary system is characterized by a deep net of financial interdependencies in the form of dollar-denominated assets and liabilities that would be extremely difficult to unweave. Now, all of this said, it is undisputable that we're living through times of significant change. As the speakers before me hinted at, the increasing weaponization of economic interdependencies in the forms of sanctions, export controls, investment screening, and so on, discourages further integration. At the same time, the digitalization of economies and societies that we're living through has no precedent. And this can unleash forces whose effects are very difficult to anticipate. So as the excellent work that we'll be discussing today now shows, many countries are looking into digital currencies or digitally enabled alternative payment infrastructures. And this may very well be aimed at chipping away from the existing systems. So if geopolitics provides the rationale, then digitalization might provide the mean to shake up the system as we know it today. Where we see signs of economic fragmentation in the shortening of global value chains, for example, well, the fragmentation of the digital space is much more advanced. For example, the legal frameworks for cross-border data transfers are becoming increasingly brittle, and the internet of certain countries are becoming increasingly isolated. Now, the concern that digital fragmentation might spur economic fragmentation and eventually monetary fragmentation is real. And while the existing system has held up so far, in the context of structural change as we see it now, past performance is not necessarily a good guidance for what's to come. And that's why I very much look forward to the discussion that will follow. Thank you for your attention.
Many thanks, Michele, for this introduction. This was a perfect kickoff for our discussion, especially I think your remarks of the current state of international payment system, but also the US-China economic relations. And indeed, if we look at the trade data, also investment remain very strong. So I think your final question is a very challenging one. If this growing fragmentation digital space can give rise or lead be in any case a big driver towards a fragmentation of monetary system. That's a real possibility, and we need to discuss it. So there will be now a change of table or change of chairs, and I will give now the floor to my colleague Nicoletta Pirozzi, who will chair the panel.
Thank you. Oops. Good afternoon. And I invite the speakers to join me, those that are here. And of course, we have a few speakers connected online. So again, good afternoon. My name is Nicoletta Pirozzi. I'm the head of the European Union program here at the Institute for International Affairs and Institutional Relations Manager. And it is my pleasure to moderate this session on digitalization and geopolitics. We don't have so much time, so I go straight into the discussion. We have a great panel composed by the authors of this book on digitalization and geopolitics, Catalytic Forces in the Future International Monetary System, which was recently published by the Nuova Cultura in the II Research Studies series. Let me introduce, first of all, our speakers. We have online Brigitte Decker, Research Associate at the Kligendal Institute, Luca Fantacci, Associate Professor at the University of Milan, Ananya Kumar, Associate Director on Geoeconomics Center of the Atlantic Council, Daniel McDowell, Associate Professor at the Maxwell School of Citizenship and Public Affairs of Syracuse University. And here with us, Irwin Voloder, Senior Policy Fellow at the European Blockchain Association, and Kai von Karnap, Analyst at the Mercator Institute for China Study. Welcome. We agreed that we will have a first round of brief introductions. I again encourage the speakers to stick to the 5, maximum 7 minutes we have agreed. And then I will open the floor. I encourage the participants to engage with our authors. People that are here can, of course, just raise hands, and the people online can use the Q&A function. So let me start, first of all, by Professor Luca Fantacci. Professor, looking at the historical precedents and current trends, especially concerning the international role of the US dollar, what are, in your view, the possible future developments of the international monetary system? Please, the floor.
Yes. Thank you. Thank you so much. And apologies for not being there in presence. So we have graduations here, so I will have to leave you in slightly less than an hour. Thank you for this question. This is indeed the main point of our contribution. And it drives our attention immediately to a paradox of the situation that the keynote speaker so well outlined. He was pointing to what is normally described as the current foundation of the US dollar hegemony. Namely, as he was saying, the fact that the overwhelming majority of financial assets throughout the world are denominated in US dollars. In other words, the dollar area and dollar assets are regarded as the destination for a large part of global savings. And to put it in the words of US Treasury Secretary Janet Yellen, the liquidity of US financial markets are in fact the anchor of the international function of the US dollar. In other terms, to use a formula, the dollar is solid because it is liquid. It's a paradox, but especially it appears as a paradox if we look at it in historical perspective, as you were suggesting. Because the dollar became the dominant currency worldwide in a situation after World War II under the Bretton Woods agreements, where there were no liquid financial markets. In fact, one of the distinctive features of the Bretton Woods system was capital controls. So the reason why the dollar became the international currency was not the liquidity of its markets, but the convertibility of the dollar itself in terms of gold. When the dollar convertibility was suspended in August 1971, that's the moment where the dollar ran the risk of losing its hegemony, and the dominance of the dollar was threatened by inflationary pressures and by the devaluation of the dollar itself. What allowed the dollar to maintain its position was precisely the liberalization of capital movements. This is one of the theses that we raise in our contribution. Let me explain. The idea is that there is, by then, in the early 1970s, an overflow of dollar-denominated liquidity, which is causing the devaluation of the dollar internally and externally. The opening of financial markets and the deregulation of financial markets allows this mass of dollar liquidity to find an outlet in markets that are not just the commodity markets, but financial markets. So, so to speak, the inflationary pressures are diverted from commodities and specifically from oil to financial assets. And this is what allows the dollar to maintain its dominance and to make the so-called Volcker shock effective. It was a time at the early 1980s when the central bank in the United States raised interest rates, and this allowed to prop up the value of the dollar. What does this tell us? What does this story tell us about the present situation? Well, in many respects, many observers and analysts have said, We are in similar times with respect to the 70s. Again, we are forced to face inflationary pressures. And again, the response is a hike in interest rates. So a repetition in a way of the Volcker shock. The situation, however, is very different in terms of, I'll just mention one and decisive aspect. The level of debts, and particularly of public debts, that characterize major economies. The United States in the early 80s had a 30% of public debt to GDP ratio. Today it's 130. Italy was 50, today it's 150. And this, of course, creates problems because the rise of interest rates, as we have seen, causes these debts to depreciate and the bank balance sheets to suffer. So what can we envisage? On one side, of course, we can envisage a restoration of the dollar dominance, but this depends on the possibility of striking this delicate balance between staving off inflationary pressures and preserving price stability on one side and not jeopardizing financial stability on the other side. The alternative, once again, is pretty much in the line of the scenario that was being drawn by the keynote speaker. Fragmentation. I would add some details to this, not just geographical fragmentation, and we're already seeing some of this, but this is also a functional specialization, meaning different currencies for different purposes. And what we see, in fact, is an increasing internationalization of the Chinese currency that takes the form not of a reserve asset, not as a unit of denomination for capital markets, but increasingly as a means of exchange for trade and for the denomination of trade finance. And this was in recent data from SWIFT. So this creates the possibility of a specialization with different currencies doing different things. And ultimately, I believe, to conclude, that this is a process that needs to be governed if we don't want it to take the form of a very disorderly evolution.
Thank you so much, Professor, for this broad background and also for keeping the time. I would like now to turn to Irwin Voloder and to ask you, what do you think would be the consequences of the launch of a digital euro for the international role of the European currency, but also more globally for the European Union role in the world?
So I think it's important to preface first that the world that we find ourselves in 2023 is not the world that the framers of the European project found themselves in, for example, in 1991. And the role of the euro in 1991 is not the role of the euro in 2023. So the issue of internationalization kind of wasn't on the menu, so to speak, around that period, and for good reason, because the EU was concerned with its own domestic issues. Now, as of 2018 and onwards, with the communication on the let's say the international role of the euro by the Commission, there's been this push to create the condition necessary for the euro's internationalization. But if you take a step back, even to 2008, for example, prior to 2008, the role of international financing debt issued in euros was somewhere around 40%. After 2008, that fell to 20%. And then you still have the euro sitting at around 19% of the basket in terms of the global reserve currency status, but unfortunately, that's about where it was in 1991. So it's kind of flatlined in that regard. And the thing with a CBDC in general, and I will say this, that a CBDC built on blockchain-enabled payments could collapse time, distance, and price to a point mass. And this makes it extremely interesting for everything from machine-to-machine payments, efficiencies in cross-border payments, bidirectional clearing, foreign exchange trading. However, the way that the digital euro is currently being framed is more within the complements of the retail payment strategy. So the ECB is exploring, for example, everything from negative interest rates on the digital euro to caps on the accounts, roughly around 3,000, with a waterfall. So, for example, if you go to 3,001, it'll waterfall into your commercial bank account. And then again, they're facing this challenge where the domestic payments landscape is still, by and large, also controlled by big techs, which are not EU listed companies. I mean, they're foreign. For example, Google Pay and Apple Pay. Similar situation, for example, with WeChat Pay and Alipay, together having about 91% of the payments market in China. So this is a problem that the ECB has tried to contend with in terms of the design options. For example, you have Spain's Caixa Bank, which is handling the prototyping for the online payments, P2P online payments. You have Worldline, right, French company, which is prototyping the offline P2P payments. Then you have Italy's Nexi, which is prototyping the POS, the POS transactions for the payee, and you have the European Banking Federation's EPI, European Banking Consortium's EPI initiative, which is prototyping the POS payments, POS transactions for the payers. So there's this idea that we need to obviously create and ring fence a CBDC primarily within European context. I would make the argument that if you do not internationalize a CBDC, for example, operationalize it for cross-border payments, and if you just keep it domestically ring-fenced, you miss out on the larger opportunity, which players like, for example, China with ECNY will not do. And I'll draw a small example. Currently, Huawei has somewhere around 15% of the mobile phone market in Africa, right? Going back to 2011, take Kenya as an example, like 80% of Kenyans didn't have a bank account, right? But over 80% of Kenyans use mobile banking. Africa is currently the hub in the world for mobile banking. So citizens that are, let's say, financially not included within the broader context of the banking system are increasingly reared on digital payments. So it's not a stretch of the imagination to assume that if an ECNY found its way into those low-value payments on the African continent. For example, even if you siloed the functionality of the ECNY, for example, tied it to rebates or promotions online, that you could disintermediate that ecosystem quite quickly, and it would become quite popular. The fact that, for example, in Nigeria, when the eNaira launched with a lot of fanfare in 2021, you found very quickly that nobody wanted to use it, and people are now burning down ATMs because the government is kind of siloed and shut off the ability to access cash at a higher withdrawal rate, right? So it really is important for the euro area to consider that if you're going to launch a CBDC, everything from machine-to-machine payments in a situation where the machine is a consumer to situations where this can support norm entrepreneurialism at the level of, for example, the Global Gateway, which was itself meant to be a democratic alternative to the Belt and Road Initiative. These things are part and parcel. And we have a situation as well today where the yuan makes up, what, 12% of the IMF special drawing rates? But if you had a BRICS weighted average of the SDR, specifically for development financing, the yuan's at like 40%. So if you draw that argument, then the euro stands a lot to lose by not being in lockstep with what other countries and other jurisdictions are doing. Now, the biggest challenge in this is that the monetary law implications and the cross-border implications and the cross-jurisdictional implications of a CBDC are difficult to solve, right? So you have initiatives like, for example, SWIFT, connecting digital islands, which have found a way to use SWIFT's interbank communication system and link domestic CBDCs. You have Project Icebreaker with the BIS, which is on something similar. You have the Project Stella phases 1 through 4, right, which the ECB has tested with the Bank of Japan on cross-border payments of wholesale CBDCs. So it's a cognizant fact that in order to achieve an international CBDC, issues of jurisdictional equivalency need to be solved, and it would be a missed opportunity to not build those rails also with respect to money at the level, programmability at the level of money and not just the payments.
Thank you, Irwin. I will now go to Brigitte Decker. Hope you can hear me online. So Brigitte, in your contribution to the volume, you identify two major trends in the ongoing process of digitalization of the financial system. One is the proliferation of financial players, and the other is new initiatives to regulate the financial system. Can you talk a bit about that? And also, what are, in your view, the implications for the EU institution? Thank you.
Yes, thank you so much. Also for having me online. I would have really liked to join, but unfortunately my calendar did not allow for that. So, but with the Europa League playing tonight at Roma, I think you already have enough Dutch people in your city, so you will be fine. I've written my chapter with my colleague, Michael Kano-Heijmans, who could unfortunately also not be here online today. And basically, we dove into the different futures for the digitalized global financial system, and more specifically, so how Europe can deal with the ongoing politicization and weaponization of the monetary system. So really our starting point was that in the last decade, the digital transformation has shaken many sectors. And of course, the banking sector is one of those sectors, which was quite well established in Europe and is now profoundly shaken by new digital actors. And we saw throughout our research that this competition emerged mainly due to new technological possibilities, and specifically three actors entered the domain. So we saw fintech actors creating technologically enhanced, more user-friendly, efficient, affordable applications. Simultaneously, we saw big tech actors such as Apple or Google who are trying to encapsulate those fintech applications into the traditional products. But by doing so, they're reaching directly like their vast and extensive user base with relatively ease. And then we see decentralized finance, which is still more upcoming, still more becoming mainstream, but these innovators are really building a radically new global open source infrastructure as alternative for the existing financial system. So we saw that these changes had vast consequences for the geopolitics of finance, and we decided to look at the future scenarios to see what kind of scenarios could there be and where should we prepare for. So we decided to organize expert sessions with people working in the financial banking sector, the Dutch ministries, think tanks, fintech startups, decentralized finance startups to think through 4 different scenarios. So on the horizontal axis, you find the concentration versus diversification. So really, it includes the rise of new players in the digital finance future, in particular, how many players there are in the game, and who will be dominating the financial sector. And on the vertical axis, we put harmonization versus fragmentation. So really looking at the regulatory pathways the world could take. And it led us basically to the following scenarios: regulated big tech banking, interoperable financial ecosystems, big tech banking goes local, and decentralized crypto economy. And we thought those through, and mainly just because we wanted to see if we could get some red lines, some conclusions that are deriving in all those scenarios, that things, even though which way it will go, we should be prepared for. So first, we found that both concentration as diversification will be challenging for policymakers. Concentration could halt innovation, with every player concentrating on the power of finance. And moreover, if big tech really was to be the one concentrating that power, you see that geopolitical tensions that are now just related to big tech, or in part related to big tech only, such as privacy and data transfer issues, will be spilling over into the financial domain, which is now still quite regulated and tight domain. So then we see diversification would also be different, as already said. Because then also within Europe, you would be able to struggle to hold up a human-centered standards for data management, data privacy, and especially the interoperability due to conflicting interests of a diverse group of financial players. And then when it comes to harmonization versus fragmentation, so the regulation of the system, we found that in every of the 4 scenarios, trust was really the key word for developing cooperation and alignment of the international level. So if trust in the financial sector decreases, the rise of regulatory fragmentation can rise and cause weaknesses in the short and medium term, but also be the reason for parallel institutions in the long term. So such breakup will lead to greater politicization of the financial sector, with various blocs promoting the preferred systems in smaller countries. Looking already a bit more ahead, so then you see that there might be the creation of bilateral dependencies that can be exploited more easily. So it was most of all a really nice experiment to do, to see how all those minds came together. And of course, we do not know what the future holds, but yeah, I hope we could spark some interest and some thoughts on how to move forward. Thank you.
Thank you so much, Brigitte. I will now turn to Ananya Kumar. I would like to ask you, beyond the general pros and cons of a central bank digital currency, what could be, in your view, the implications of the issue of a digital dollar on monetary policy, but also other related areas of policy, such as, for example, on the regulation of standards, cybersecurity, digital IDs, and similar matters? Please.
Sure. Thank you so much for inviting me. I hope everyone can hear me well. My name is Ananya Kumar. I'm the Associate Director at the Atlantic Council's Geoeconomic Center. Just a little bit of my own orientation coming into this work. The two main research questions I grapple with are about the form and function of money in the future and the architecture that enables it. And both of them speak to each other all the time. So I think we sometimes confuse our understanding of CBDCs as one and not the other. I think I want to talk about them both together today. So that's just an orientation with which I come with. As a part of my research project, I look at central bank digital currencies around the world. I currently look at 120 of them. And the question I always get is how many countries are really serious about developing CBDCs. I estimate that to be about 60 plus countries, so more than half of the countries that I'm looking at that are in the advanced stage of development. This includes 19 of the G20 countries. Obviously, the ECB, we heard comments about the digital euro. Just framing our conversation a little bit on weaponization and fragmentation, two words that have come up a lot. I'm just coming off of Bank Fund Week in Washington, D.C., where fragmentation was the word du jour. So I've just been thinking about it a lot over the last 2 weeks. But the reason I think it's important to study CBDCs as a tool of weaponization or fragmentation is because it devises new kinds of payments architecture, and it enables some disruptions on the existing architecture. So just as a framework of entering into this conversation. I think it's always useful to determine what kind of CBDC we're talking about, and that primarily relates to whether we're talking about a retail CBDC or a wholesale CBDC. The way to understand a retail CBDC is something that would let me buy an espresso. It enables peer-to-peer payments primarily on the domestic stage. It's very hard to see models of retail CBDC getting proliferated on a cross-border stage, with the exception of the ECB's model, obviously, which is crossing borders, but still working across the euro. And from a wholesale perspective, we're really referring to bank-to-bank transactions of CBDCs. So that could be domestic, that could be cross-border, but primarily when people talk about the threat of or the weaponization of CBDCs, they're talking about cross-border wholesale CBDCs. It's very unlikely that retail CBDCs are going to have any kind of sanctions evading effects or any effects on de-dollarization. I think that's a point that deserves clearing up early on before we delve further. But wholesale can't supplant our current networks. And this is an important piece of geopolitical puzzle that sort of CBDC policymakers like me are interested in. So I'd like to start with some incentives that I find convincing when countries start to develop cross-border wholesale CBDCs. It's really the question of why cross-border wholesale CBDCs here. There are a lot of arguments. The ones I find convincing are two. One is a purely technological argument. We currently have parallel architectures that separate out settlement functions from messaging functions. And we have developed technology, and primarily through blockchain DLT, that can combine both, but do them at a faster speed, at a lower cost, and with more transparency. This is a lot of efficiency gain for any country wanting to develop its cross-border capabilities, its payments networks. So just aside from judgment on why they do it, I think it's an important thing to understand that this is why countries are interested in developing these networks. The second part, and this has come up from emerging evidence after Russia's invasion of Ukraine, is that we've seen a lot of wholesale CBDCs networks develop in the last year. The number has actually doubled in the last year, which sort of suggests some sort of motivations of sanctions proofing or sanctions evading on behalf of countries trying to determine pathways outside of the dollar to settle their trade and foreign exchange transactions. But there's a lot of challenges when it comes to developing a wholesale network. Now, these challenges are not specific to CBDC networks, and we've talked about them a little bit in our earlier conversations, but I just want to talk about the challenges in order of importance, at least from my perspective. The first one is regulatory challenges. It's really, really hard to get through regulatory hurdles, even when you're trying to connect fast payments networks and things like that. It adds a lot of cost to countries to do that. Legal and regulatory challenges are sort of the #1 reason why these networks aren't very efficient. The second challenge is about liquidity and currency caps. So in a lot of wholesale CBDC experiments, again, something that we see with other kinds of swap networks or other kinds of networks as well, is that there's not enough liquidity and capital outside of the dollar to be maintaining these relationships for large volumes. And the third and important one, and something I don't think we're thinking about a lot, is about what does the arrangement look like? Are we thinking about bilateral arrangements? Are we thinking about hub kind of arrangements? Are we thinking about replicating something that the SWIFT already does and building on a network that the SWIFT already has? Or are we thinking about sort of creating a new organization itself? Who oversees this? Who maintains AML, KYC? Questions of governance and network, I think, are really important here. So those are the main challenges, I think, when it comes to building wholesale CBDC networks. I end my paper with a section on why I think US development of CBDCs is important. I lay out some of the arguments here in the US, which are around privacy, surveillance, cybersecurity, as well as the role of the private sector, both in terms of commercial banks and other intermediaries, but also the role of private crypto in all of this. The argument I make is the need for leadership by the United States as the issuer of the world's reserve currency. It's based on the fact that the next era, or this era of competition, is based on technological standards, which a lot of these CBDC models that are already proliferating and already getting internationalized create just by existing. So these standards might be AML KYC standards, it might be privacy standards, it might be digital identity standards, it might be cybersecurity standards that are not aligned with the level of a level that we might be comfortable with interacting all the time. And if left unchecked, may determine how money moves both in regional blocks and might also hamper the way that money moves in our own block for that reason. And I think the big risk here, overall risk, the last thought I'll leave everyone with, is that technology that can eliminate friction might, because of regulatory policy and because of fragmentation, create more friction in the system and make our entire payments architecture unworkable if that happens. So that's just, those are some thoughts, and I was very happy to do this. Thanks.
Perfect, Ananya, thank you very much. And before I give the floor to the next speaker, I would like to say again that people following online can interact with the speakers through the Q&A option. So I will now turn to Kai von Parnap and ask you what are the opportunities, but also challenges for China to launch its own digital currency in a view to, try to enhance its role internationally. Please.
Thank you, Nicoletta. Maybe could I ask you a favor? Could you put the clock on this table so I have an eye on this and I don't overshoot my time? Thank you, everyone, for the invitation. My name is Kai von Parnap. I work for the Mercator Institute for China Studies in Berlin, looking at science, technology, internet stuff in general. And I was really pleased to have the opportunity to contribute to this paper and address, I guess, one elephant in the room in this debate, which is China's digital currency, as you pointed out. Because there's huge discrepancy on the global discourse level, what that means, what digital currency really is, that comes from China. US would stress that it's an authoritarian digital currency. There's a Protecting Americans Against Authoritarian Digital Currency Act that has been proposed to Congress in May last year. There's the Restrict Act that has been pushed to Congress last month that basically has the aim to limit any Chinese technology, including digital currencies, from the US market. And they run around warning everyone that this is, one of the tech advances that brings China's tech lead, to a next stage. On the Chinese side, you have people running around saying, no, there's nothing to do with this. We only focus on domestic developments. And the question is really, is there any weaponization we could see here, right? So I think that's a three-part question. You could ask first, where's the technology really right now? Is there anything that the digital currency adds, and opposed to the RMB? You could look second at the role of the RMB right now, because the ECNY, digital currency, is a supplement or a replacement of the RMB itself. It's not the next currency like a cryptocurrency. It's just a supplement of that. And third, which are the regions, which are the partners that might be affected, or sort of what are the addressees of that attempt? So if we look at the tech, it's really, it's a long story, but to cut it short to the most recent developments, the Chinese pilots that are taking place in about 15 provinces right now in China, they look increasingly into adopting smart contracts and trying out programmability and introducing spending conditions, expiration dates, and so on. They use that a lot on a local level, but I think the question is really, what does that mean on the global use of the digital currency? Could you implement political spending conditions? Could you address or change expiry dates? Could you even change the purpose of units of the digital currency for the sake of geopolitical leverage, right? Both on a retail and a wholesale level. I think that's probably not something new to people that have looked into CBDCs, but it's really something we see being tried a lot. The other one is smart city infrastructure. So you can run around Chinese cities and pay basically, even with just facial recognition technology that's connected to your personal wallet and so on. That's not so relevant for this debate, but I think it's a note. But so if we look then into sort of the role of the RMB, which I think is important if we talk about a weaponized digital currency that comes from China, we see, as Fabrizio has pointed out earlier, that basically the digital currency, the RMB, has lagged behind the meaning or the importance of China's economy, with the one notable trend that trade is being facilitated more with RMB. And the study was alluded to by the Bank of International Settlements that showed they have a triennial survey every 3 years, run around and see who's settling trade in which currency. And 2022 was the first year that 7% of global trade was roughly facilitated through RMB, as opposed to 4%. It's a marginal increase, but the biggest one amongst different measures of internationalizing a currency, right? So it's mostly about trade facilitation, and then we see mostly trade in the ASEAN region. We have some countries that are really like Malaysia, Thailand, Vietnam. These countries are really interested in using the RMB because it's just much easier to use that currency to trade with China than always go through the dollar first, where you have to pay transaction costs. So the last section is so that would be the region basically being addressed with that risk. And the question now is, does China really propose the digital currency to those trading partners that are using the RMB already a bit more? And here is where the story on the pilots differs from the global Chinese, I guess, discourse, where as opposed to what they say is just local trials, we do see a lot of pilots that try to integrate the digital currency as a facilitator of trade, especially with the countries in ASEAN, so ASEAN neighbors and BRICS countries and Belt and Road countries. I'm not going to go into details too much there, but that is happening right now. I think, to come to forward-looking section, I think it's still really noteworthy that the digital currency is really just at a really early stage. It's not even 1% of cash supply. It doesn't represent less than 1% of China's total cash supply. It really is only 15 provinces, and that doesn't mean that the entire province would do the trials, but sometimes only cities. And I think if we look forward, what really impedes the growth of the digital currency right now, even though they're being pushed in these pilots to some countries, is that China has built up a really strong data governance regime in the last few years as well. So there's lots of laws that prevent certain data to leave the country or certain data to enter Chinese territory and be stored in China. And these restrictions also affect financial transactions, which is one of the main reasons why the digital currency cannot be pushed, on an international level to the extent that Beijing would want to see it otherwise. So I would therefore argue that the question of financial fragmentation in this sense is also based on the precondition that you have data transfer agreements first. So only if you have data transfer agreements that way, you can even think about internationalizing a digital currency if you have a really well-established data governance regime, as we see it in China. And that's why also Chinese Foreign Minister Wang Yi has been running around in recent months trying to foster data sharing agreements with ASEAN countries, with other data sharing and trade arrangements to then integrate the digital currency at a later stage. But as long as that doesn't happen, I think that, that probably we won't see much movement on this. And I have another point, but maybe that's more for the discussion later.
Yeah, thank you,
Thanks.
Guy. I'm sure we will come back to this during the discussion. And now, last but not least, for this first round of interventions, I will turn to Professor Daniel McDowell, who wrote the last chapter of the book. So after the invasion of Ukraine, Russia has been able to deal with some of the consequences of the Western sanctions by relying on its gold reserves. Could you explain a bit more the role of gold as a means of acquiring foreign exchange, but also the potential consequences of technological innovation in gold markets for a sanctioned state? Please.
Yeah, thank you so much. And thanks to the other panelists. I hope that everyone can hear me all right. And I apologize, I could not be there in person as well. Good afternoon to everyone who's in Rome today. This is a book about the digitalization of finance. And I'm talking about, the most antiquated form of money we could discuss, that being physical gold. So thank you for the opportunity to kind of take a turn in this project that maybe was initially unexpected. This is really part of a broader trend that we've really seen in the global economy dating back to around 2010. Physical gold and monetary gold specifically, right, sort of used to be a central part of the international monetary system, obviously under Bretton Woods, and then earlier under the 19th century gold standard. But really for the last 50 years hasn't had a formal role. Central banks through the 1990s sort of maintained significant amounts of gold reserves, but around the early 1990s, we started to see central banks become net sellers of gold. And that lasted for the better part of 20 years, to the point that central banks had to reach an agreement to slow down how fast they were selling their gold reserves because it was affecting the value of the commodity. In 2010, this begins to change. Central banks become net buyers for the first time that year, and that's sort of sustained now over the last 13 years. In fact, last year was the biggest report of central bank gold purchases on record dating back to the year 2000. So we've seen that popularity just continue to increase. So what is it about gold? I'll take this moment to shamelessly plug my book, which was just released last month with Oxford University Press, and that book's called Bucking the Buck. And in the book, I look at this specifically in one chapter, and I link it to sanctions. There are economic motivations here as well, and that's important to acknowledge, right? The lack of safe assets, concerns about the dollar's value, that's behind some of this as well. But I argue that sanctions are a really driving force in this renewed interest in gold purchases by central banks. And Russia is really at the leading edge of this, increasing its gold reserves by around 1,300 tons between 2014 and 2022. Then 2014, after the first round of sanctions for the illegal annexation of Crimea, is when we see the real uptick in Russian gold purchases. So there's an obvious link there. And so why? What's behind this interest in gold? Well, it's physical. It can be held in your own territory, in your own vaults. It can't be frozen by Washington or Brussels or any other foreign power short of a military invasion. It can be traded outside of the dollar system. So Russia helped Venezuela back in 2018 and 2019, another country heavily sanctioned, fly its gold around the world and sell that gold in sort of gray markets and get cash, which could then be brought back into Venezuela. Obviously, gold has some real downsides as a monetary asset, right? It's largely illiquid, especially when you think about physical gold. Transporting gold around the world by airplane and selling it for cash is not sort of something that can easily be done and has a lot of transaction costs. But there's a trade-off here between liquidity and security. And so I view it sort of as doomsday prepping for central banks, if you will. And you're right, the piece that I wrote really kind of starts there and then says, how did Russia's gold help it weather sanctions? And very briefly, I know my time's already running out here. I sort of identify two main ways that it seems to have helped. Is one, there is some circumstantial evidence. Russia stopped releasing data on its gold reserves, so we don't have actual proof of gold sales. But there's some evidence that there was a surge in imports from UAE into Switzerland. Switzerland's a major gold refining hub, and UAE has operated sort of as a laundering point for countries that have been sanctioned in the past. To sell their gold and then sort of move it through third countries in exchange for hard currency. And so there's some evidence that may be something that Russia has done. On top of that, we know that Russia's been exporting a lot more gold to China, which is being sold in Shanghai. There's a growing gold market there, not a rival to London, but potentially in the future that may develop. The second area where gold may have helped Russia was in sort of serving as an anchor for the ruble. Russian policymakers encouraged Russian savers to, if they wanted to exchange rubles for something, don't exchange them for dollars, right? We have capital controls. In fact, we can't have you exchanging them for dollars. That's going to tank the ruble's value, but exchange it for gold. Gold is a reliable store of value, and it's less risky than the dollar. This is effectively what they were told. And Russian policymakers even eliminated a value-added tax within a few weeks of the invasion that made it more attractive to buy gold, reducing sort of the costs of purchasing that. And there was a significant surge in retail gold purchases at the counter of major Russian banks within the first month. World Gold Council data backs this up, as well as reports from Russian banks themselves. And so it does seem like gold may have served as sort of a way for the Russian state to calm the nerves of Russian savers who are worried about the value of the ruble and sort of direct them away from exchanging rubles for dollars into something else. In terms of the future, and I'll wrap it up here, right, we should pay attention to the further development of Shanghai as an alternative market to London, and one that might be attractive to folks who are attempting to evade sanctions in the development of an RMB pricing mechanism for that. Secondarily, just the long-term potential for the development of a gold-backed digital token and the use of blockchain technology that may improve the tradability and liquidity of gold assets. The World Gold Council has discussed this. There's actually a group in the UAE that has sort of launched a pilot. And so those are things I think we could pay attention to in this area. Thank you.
Thank you, Daniel. And before I open the discussion in the room, since I know that Professor Fantacci has to leave a bit earlier, and I already a question for him, if he can hear me online.
Yes, sure.
Perfect. So, yeah, a question by Flavio Brugnoli online. Do you see any perspective, at least in the medium term, for the SDR also as a vehicle for a soft diversification of the international monetary system?
Well, thank you for that question. The answer is definitely yes. And I believe I'm not the only one seeing it this way, because just a couple of years ago, there was a huge allocation of SDRs. You all know this is the international currency issued by the IMF, which would, you say, a soft diversification. Yes, it would at least contribute to solve one of the contradictions in the current international monetary framework, which is known as the Triffin dilemma, the requirement for the US to run a balance of payments deficit in order to finance an expansion of global trade and investments. Now, this massive allocation of SDRs shows that there is the intention of providing liquidity in a different form, which would not involve the external position of the United States to expand beyond the already frightening figures that were given us by the keynote speaker. What I find interesting is that in the wake of the global financial crisis in 2009, there was an explicit proposal by the People's Bank of China, the Chinese central bank, to base a reform of the international monetary system precisely on expanding the role of the SDR and possibly, and this relates to what Daniel was saying a moment ago, basing the international currency on a basket of commodities. So moving away from a financial notion of international money as a reserve asset and looking at the liquidity of international money in terms of the accessibility of basic commodities, not just gold, clearly, but energy resources and so on. And there has been some movement in this direction, particularly by China, in expanding the role of the yuan in energy markets over the past few months. So I think these are all symptoms of a possible direction that should be more openly discussed in view of redesigning the international monetary system. I take the opportunity to thank you once again, and indeed I will have to leave for graduation session. So thank you all very much.
Thank you so much for being with us. And Kai, I don't know if you want to maybe add also the point you didn't have the time to address in your intervention.
Yeah, thank you. Yeah, that's a great question, also a great answer, Luca, to address some of the concerns and ideas around the SDR. I think what is behind that is a bit of a discrepancy also from the Chinese side to argue that it wants to have a powerful currency, it wants to have a more meaningful RMB on various markets. But you see that that comes with lots of risks too, and the question is, why don't they address the problems that they know are facing the lack of an international role of the RMB, and it's because of the risk that they are aware of. And I think it comes one with just a liquid currency that is not in the interest of the Chinese economy. So you keep having quite rigid financial controls. But I think the other one is that they know that also you need trust in the institutions, and you need trust in the political economy, you need trust in the government to uphold a certain value that, that either is, due to market forces or due to, set value that everyone believes might maintain in the future. And the thing is that, the trust in the Chinese government, the trust in the Chinese political system is quite low. So whatever, the financial regulations be, the trust issue will prevail. And I think one thought I had in addition to what I said earlier is that if you have these spending conditions that you could introduce through programmability and smart contracts in the digital currency, and you would use that, you would further undermine the trust in that currency. So even if that might accrue to some geopolitical leverage on a theoretical level, it really erodes the one thing you would need most for a more international role of the RMB, which is trust. So maybe just adding some thought to that diversification problem.
Thank you very much. So let me check if there's anybody in the room that would like to ask a question or a comment. For the timing, I see Ananya with her hand raised. So please, floor is yours.
Thank you, and thank you, Kai and Luca, for your really great comments on ECNY. I just wanted to give a little bit more perspective, just coming from my perspective on the ECNY, just a little bit of self-promotion too. I have a new piece coming out hopefully next week on China's ambition with ECNY, both domestically and abroad. I think it's important to look at it with a certain amount of distinction. I think it often in the US gets conflated. The retail and cross-border use cases get conflated. So making that point again, but just on the cross-border use case, I think so far from the domestic perspective, I think China is currently in a test and learn mode, as Kai described, prioritizing experimentation really over adoption. We've seen adoption numbers be really low, and people not really, even if they're sort of download the wallet, not really be using it in any kind of transactions. And a part of it is because the competitors to ECNY are fintech solutions like Alipay and WePay, which again cover a broad swath of the market and are very popular, and people aren't really incentivized to move out of it. But a lot of use cases being tested currently are in public transportation, for example, or in enabling securities purchases, credit payments, things like that, things that are trying to get audiences to move on to the wallet. On a sort of international perspective, I think this is my perspective does not reflect my employers, and this is what the piece is going to argue for, which is that China is less focused on internationalizing the RMB than it is focused on setting technical and regulatory standards that will determine how other central bank digital currencies will work going forward. I just wanted to put that point out as well.
Thank you so much.
If I could just add to what Kai and what Anya were saying, and I know recently the Total Energies they completed an LNG trade for roughly about 65, I think it was 65,000 tons of natural gas that was routed through the UAE into the Shanghai Petroleum Natural Gas Exchange and settled in digital yuan, right? So when you compare that to the value and volume of, for example, natural gas settled in US dollars, it's a pittance. However, it does point to the fact that it's, you know, the expression "don't poke the bear." It's like it's slowly poking the bear in terms of seeing at least at the margins what can be accomplished, and then how that can be amplified, perhaps through what President Lula was saying, or Xi's overtures to the Gulf Cooperation Council, right, to start pricing Saudi oil in yuan. How these things could be amplified on an international scale to maybe exacerbate that let's say diversification out of the greenback more so than within, to what our keynote was saying is feasibly possible at this point without massive repercussions to the international monetary system. And then also to your point, Anya, it is this this tension between what is like on the retail side and on the side of a wholesale CBDC. If you do go the way of programmability at the level of the money, so for example, with smart contracts, and Monetary Authority of Singapore is doing this with Project Orchid right now, they're calling it purpose-bound money. Number one, you run into the problem of what does that thing actually mean from a perspective of monetary law? Because if it behaves more like a voucher, is it actually like cash? And that's just a basic point. Another point is obviously the confidence problem. If you start adding political conditions, you said, Kai, to the money itself, you might lose a lot of people along the way. The flip side of that is for things like IoT-based payments, like if you have a self-hosted wallet that can settle that, where the machine, for example, has legal agency, it can attest to payment itself, you kind of need smart contract-based payment functionality in order to settle those. And not having that then leaves you at the mercy of not being able to participate in what I mentioned earlier is the machine is a consumer economy. And this is kind of that, let's say that divergence in the future of when IoT, blockchain, and AI will kind of melange into one slipstream. We're obviously not there yet, but there is an argument to be made that we could have programmability at the level of the money if we do it in a way that obviously doesn't lose the political agency and the people along the way.
Thanks. Maurizio, I think you had a question.
Thank you, Nicoletta. First of all, thanks a lot to all the authors of the book, of the co-authors. It was very inspiring to coordinate with Nicola Bilotta this research project. There's something I would like to ask a further reflection analysis on what could be the implications of this trend towards a more diverse international monetary system. Someone may see some even positive consequence in terms of competition and all the discipline that it may entail for responsible for policy on currencies. You may also have the positive effect for example, diversification, for having other assets when confidence is low or is lacking. But you may also have the problems associated to transition, the relocation of financial flows to other assets. What do you see? It is a welcome outcome for the future, for the long term, as we said, a more multipolar international monetary system. Thank you.
Okay, Thank you, Fabrizio. I think this is a perfect opportunity also to give the chance to the speakers to address a final word to the audience. I will start in reverse order. So Daniel, please, the floor is yours.
Yeah, so it's a great question. And again, thanks everyone for being here and for the chance to participate in this. I mean, I think my view is that some of the talk about diversification and its the potential for it to sort of significantly disrupt the dollar's sort of dominant position is a bit overblown at the moment. It's not that I think there's nothing here. I think that we will see more tinkering around the edges, and innovation always has the potential to disrupt. But just to answer briefly and then kick it off to the next person, I think the real issue here for the United States, for Europe, to consider is the potential for sanctions evasion in the future, and for the diminishment of the coercive power and the power of sanctions to degrade an adversary's capabilities. So to the extent that there are alternative networks or pathways, even if they're less efficient, less desirable, they present avenues for targeted states and non-state actors to continue to participate in cross-border economic activity outside of the systems where they can be monitored and can have their transactions controlled. So I'll just stop there. Thanks.
Thanks. Hi.
Yeah, maybe just one point on that, Daniel. I haven't addressed any thoughts on the sanctions shield question. And that's basically an assumption that, that I think you have addressed in the keynote as well, which is, does it really, how could the ECNY really help avoid sanctions? And the overwhelming argument is really no, it couldn't, because secondary sanctions will still apply, A, and B, you will become the target of the Chinese Communist Party's political, heft much more than with any other currency. So you don't avoid, you might avoid some US sanctions, but you become, you get into the transparency system of a digital currency controlled by another an authoritarian regime. So I don't think that's a good argument. There's gold, for example, as you pointed out very well, that much better sanctionship. But Fabrizio, yeah, I think the long-term consequence, I don't know, I feel it's really more of a transaction cost question, the way you phrased it, which seems like the more fragmented financial systems and payment systems become, it just becomes a transaction cost problem for users, for countries, and there's not much benefit that outweighs that. That's really my feeling, because they're not seemingly interacting. Interoperability is something that has to be worked through, very carefully. And we talk about the data, cross-border data sharing agreements I pointed out that are necessary to facilitate some of that. But it's not only that, it's tech standards. Anjana has sadly left us before she could give an answer to this, but I think rightly so. Oh no, she's with us. Oh great, sorry. I just didn't see you. I think that's a very good point. Yeah, tech standards are really something that China wants to achieve too. So that will make that interaction between currencies even more problematic, more costly. So I think at the end there's really more negatives on that fragmentation world that we discuss right now.
Thank you, Alania. Please, over to you.
Oh, I was summoned. No, I think I agree with everything that's been said, but I just will also add the point about regulatory standards, especially data governance standards, as not just payments, but other services also get digitized over time. How we store data, how we transfer it is going to become more and more important. And someone at the beginning said that data governance regimes are getting even more brittle than they were before. I think I completely agree with that point. None of these challenges are sort of specific or new to central bank digital currencies. They're just a sort of a way of thinking about further digitization and how when accompanied by geopolitical motivations, digitizations can make fragmentation worse. That's sort of my last point there.
Thanks, Bridget.
Thank you so much. Yeah, I agree with everything that has been said. And if I take 1 minute to add something really small, then I would say that it's really good that we see that digitalization has really been a key driver of change within the financial system, and that, of course, it brings a lot of difficulties, but also, as asked, a lot of positive outcomes for the global south, for more rural areas. Connecting them to the financial system is already an outcome. And I think it's also been good for the European Union as a whole to see that they woke up basically in a world where diversification and the financial system has suddenly been not that established and very bureaucratic system that it always has been and that we see and know in the European Union. So I think moving forward, the regulatory system and thinking about how it will impact our lives will be necessary. So thank you so much for having me here today.
Thanks. Ilwi, final thought?
Yeah, so I completely agree and echo what the other panelists have been saying. I think when it comes to, for example, digital, let's call them digital currency areas of the future, CBDCs likely won't exist in a vacuum and aren't a panacea for everything. So you have, more and more discussion and research around deposit tokens, for example, and then you also have privately issued and well collateralized stablecoins, which will likely remain part of this mix. And it simply becomes a question of how do you foster interoperability and common regulatory standards, not at the margins, but at the core. And this is extremely difficult because these systems need to speak to each other in a way that the data is interoperable, and they also need to facilitate the economies of scale and the cost savings that they purport to achieve. And for example, you have the regulated liability network, which was proposed by Citi to kind of group all of these regulated liabilities under one umbrella and to try to foster these interoperable standards. Aside from this, again, you do have China, for example, being very vocal in the International Telecommunications Union, for example, to foster and promote their version of what those standards should look like. And I think there really is a place for Western democracies to be more vocal in terms of fostering these standards and to help design the digital currency areas of the future in a way that will kind of instill and promote those democratic values again at the core and rather than at the margins. Otherwise, fragmentation could carry other negative externalities that are at this heretofore unforeseen.
Thank you very much. So we have concluded our session. I would like to thank very much the speakers and authors that intervened today. And of course, if you want more details, you can download or buy the book. And thank you again to Intesa Sanpaolo for the support. And yeah, we'll keep in touch. Thank you so much.